So, Faisal, it's obviously been a pretty turbulent couple of weeks, but the VIX, I was noticing, is back down now to under 16. We still have the S&P 500 below 5,100. What's the outlook from here?
I think still we believe that the sector sort of leaders that have performed in the last 2 to 3 months, which is energy, materials, and to some extent financials, I think they will continue to lead. I'm not that much bullish on the tech part as of now. We'll have to see the earnings. Yes, we saw the recent earnings. That was good from the bellwether stocks. But let's see whether there is a kind of a momentum, sort of a downward trends in the tech stock. And I think much more needs to be seen from the corporate earnings and the expectations. So the results from the Tesla that we saw, I think market is all about expectations. So that's what is going to be the trend from now on.
Well, the end of last week in particular was a good reminder to investors that a lot of wealth can be destroyed very, very fast with that 10% drop for Nvidia, which has now obviously retraced some of those declines. But more broadly, we also saw a little bit of weakening in US economic data with business activity coming in a little lower and a contraction for the manufacturing PMI. Does that concern you at all, or perhaps maybe it enthuses you because it gives the Fed more of a green light?
I think still we need to see much more data points on the inflation, because we are seeing still, and on the 26th we will see the Fed's preferred indicator, which is the PCE, come out, and let's see how that goes. But overall, I think U.S. economy is in a good shape, and I think we are more going towards the camp that probably rates for higher is giving more money in terms of the bondholders, the generation, and that they are spending. So I think U.S. economic growth seems to be going strong. Again, it will be data dependent, and see how that, because that labor market is going to dictate how that growth is going to be.
It's fascinating because with all of this, we've had a stronger US dollar, and that strength is still there, and emerging market currencies have really been hurting recently. I mean, we're off our, extreme points, but still, you like emerging market local currency debt. Explain why.
I think from the interest rates perspective, I think these guys have got the financial flexibility to ease much more and much faster. And then, according to me, I think much of the emerging markets, especially on the Southeast Asia, some of the currencies are undervalued from 10 to 15%, and that gives the local currency bonds an edge, where it gives a good yield plus the appreciation from the currency perspective.
Assuming that the currency appreciates, right? I mean, does that not depend on what the Fed does and when it does it, and how these other central banks can respond?
Of course, and if you look at the developed market central banks, like, yes, we have seen that now that there is a delay in the Fed's action that is expected, and we expect probably the rate cut, if it happens this year, probably will happen in the fourth quarter, as compared to our expectations in the third quarter, and 3 rate cuts, probably it might be 2 or probably 1 this year. So that changes. And from the other developed market perspective, I think probably ECB and Bank of England might cut the rates sooner than the Fed, because the inflationary stance there is due to different segments. So I think yes, probably in that case, emerging markets will ease much more faster than the Fed.
So what else are you liking at the moment? Because if everything has been pushed back to the fourth quarter in terms of what the Fed does, is there anything you can do in the meantime to take advantage of that situation?
I think from again, on the developed market side, Japan looks good, and in terms of their what you call shareholders friendly reforms that we have seen from the valuation perspective. In the monetary policy, the central bank has taken the first step, and we have to see how that goes. So Japanese equities still look better, and I think we should start looking at China again, because we saw a lot of pivot from China to India, but I think China still has much more firepower within themselves in order to prop up the economy, but we'll still have to see how does the shadow banking and the real estate sector performs there.
The problem with China is that we've been saying this for a long time, right? Since the opening, in fact, really, I mean, a lot longer than that, but just most recently. And it feels like investors just aren't buying the China story yet. Where would you go if you were looking at China?
I think more on the energy and materials again, because overall I think energy market is becoming strong again, and that has helped. And even on the financial side, some of the China A stocks looks on the valuation side But again, we'll have to look at overall the economic data and the kind of efforts the regulators and the Chinese authorities put in order to improve the market.
You're obviously in local currency debt in lots of emerging markets. Where do you see yields in the US headed in the shorter term?
I think we are looking at we are more bullish on the high yield space in the US, and I think probably the yields will now remain range bound, but in the high yield space we are looking at a short end of the curve, because then you can get a yield of around 7-8% on the high yield and without taking too much credit risk. So I think the yields will remain range bound, but whether on the 10-year will it reach, let's say, 4.8, 4.9, maybe.
How much in cash are you?
We are, from the asset allocation perspective, yes, we are on cash because the cash is yielding. But now I think it's more going towards the equities and on the high yield side.